bonds are now, instead of being negatively correlated, so that when stocks go down, bonds go up, and when bonds go down, stocks go up. Now they're kind of moving together. So instead of it working against your equities to kind of prop it up, it's working with them and dragging everything down, and it yields less. And so this is the kind of environment that we're in. It's not straightforward. It's not cookie cutter. This is a difficult environment. Welcome back to Goodrich Financial Advisory. Today we're going to go over kind of broad picture economic environment in the market and in the economy, as there's a lot happening and a lot changing. And today's kind of a great example of why the narrative for the last 15 years, all the way to probably about 2021, kind of really doesn't work anymore, and what inflation does and changes market behavior and dynamics. So the first thing we're going to look at is a quick chart from the BLS showing their GDP release. So as you can see, it's lower than any other point on this chart. However, they expected it to be lower, but not quite this low. So this came in at 1.6% annualized. So if the economy were to continue to grow at the rate it did in the first quarter, total growth in GDP for the year would be 1.6%. Their expectation for this quarter was 2.5%. So that's a 36% miss. It's a pretty big deal. On top of that, last week we had inflation data. So we have for March, all inflation. So headline inflation was 3.5%. Core inflation, which is the Fed doesn't want to look at food and energy. So what they're looking at is 3.8%. But as you can see, it's not coming down below this 2% target that they keep freaking out about. Like, oh, it has to get under 2, it has to get under 2, it has to get under 2. As you can see, this chart just doesn't really look like it's trying to get under there. So what does that kind of mean? We're going to quickly look at the 2-year and the 10-year. So the 2-year rate is supposed to be under the 10-year. If you were going to lend somebody money for 2 years and you wanted, let's see, this is at about 5%. But then if you lent the same friend money for 10 years, do you think you'd want more back over that 10 years for taking that risk of letting them borrow it for that long? So that's what a inverted yield curve is. And so if we look at, this is the Federal Reserve's website, the 10-year Treasury constant maturity minus 3-month Treasury. So if we look at an even shorter duration, borrowing money for 10 years is cheaper than borrowing money for 3 months. So this black line is zero or parity, where they're worth the same. But the 3-month has been yielding more. This goes back to the inflation numbers. So as inflation goes up, and yet people have panic or concerns about the market, you start seeing weird things like this. So this is a warning sign. If we zoom out, there's an inversion before 2020 and the pandemic, which indicates that we were probably going to go into recession before the pandemic. And all the money printing that happened during the pandemic kind of kicked that can down the road. And oh, look, the sugar high ran off, and now we're back. Same thing happened with 2008. This inverted deeply before the recession, came uninverted, and then still had a waiting period time, and then the recession hit. So it's kind of really what I wanted to hit on that portion, kind of set up the background. Inflation is high, and the market is concerned about the economy. So what happened in the market with that setup? Normally, when you have something like this, so this is the S&P 500, it's got an upward bias, kind of goes awesome, awesome, awesome. We got over 5,000. Yay, everyone's happy, all their retirement accounts. But if we zoom in a little bit, let me move my head out the way. The last couple of days, each one of these bars is a day. And as the market's been kind of moving lower, we got some bounces. The weird thing that's kind of been happening is if we look at bonds, so if we go over here, look at bond futures, let's look at the 2-year. Oh, that's weird. Bonds have been selling off with the market as well. Let's not look at the 2-year. Let's look at the 10-year. There we go. The 10-year bond has also been selling off as well. That's kind of odd. And the 30-year has been selling off. So why is this? Why are bonds selling off at the same time as stocks? Normally in a 60-40 portfolio made popular by Ray Dalio, also known as risk parity, bonds are supposed to be the anchor or the ballast in your portfolio, so that when stocks go through a problem or have an issue, there's something to kind of push it up. Well, if we sit at inflation being up here at over 3%, bonds are now, instead of being negatively correlated, so that when stocks go down, bonds go up, and when bonds go down, stocks go up. Now they're kind of moving together. So instead of it working against your equities to kind of prop it up, it's working with them and dragging everything down, and it yields less. And so this is the kind of environment that we're in. It's not straightforward. It's not cookie cutter. This is a difficult environment. An environment like 2020 where everyone's panicking, it's a little easier because there's panic in the market, and everyone goes and freaks out and buys the 10-year. Then you have a bunch of money printing, and then people jam money into stupid crap, and they say, yeah, with meme stocks and diamond hands and GameStop to the moon and every other thing in the world. But I just wanted to show this example today of what happens in the market in this new environment that's not necessarily straightforward. It's not cookie cutter. Things are changing and people are trying to figure out what's happening. So, anyways, until next time, talk to you soon.